My name is Jay Bridgeball. I'm a real estate broker since 1988. I've seen the good days, the bad days, and the not so bad days. My passion is to educate consumer about all aspects in real estate. Actually, I sold over $1.75 billion in real estate. Now, that's a lot of experience. I went through many failures, many successes, and I've seen many stories that you will be amazed. Not everything looks so glamorous as it is sometimes. On Let's Talk Real Estate, we will dig deep down and I will take you step by step through every process, from buying your first home to buying a multi-million-dollar investment property. We will have various people on this show: lawyers, investors, we'll have mortgage brokers, appraisals, and everyone else to assist us to take you to that point. My aim is to break it down in such easy terms that you will be able to follow. So please join me every Thursday between 1 and 2, and let's talk real estate.
Let's talk real estate. I'm here with myself, obviously. Amit Kanhai, your host, and I have a special guest, Varsha Maharaj. As you can tell, that is not Jay Bridgepal. This is Varsha Maharaj. All right. So, what we want to do on this particular episode, as you know, Varsha, we're tackling what it's like to be under 30 and wanting to purchase real estate. So it's kind of
essentially me.
Yeah, it is definitely you. And you also have some background information because you've also worked in the real estate field and as well as some office admin and things like that. So we're just going to jump right into it. Segment 1, 2, and 3, most of this stuff, and then another market update. So I know you have a bunch of questions, so
I definitely do.
I'll let you get started. What's some questions that are kind of top of mind?
So I think the first thing in terms of basics for any person under 30 that hasn't been in this realm is, what are the basics of the process of going through buying something?
Right. Okay, so I'm glad you asked that because that's actually something that we at the Bridge team, we've condensed into a very quick like 15, 20-minute presentation. It's actually about 45, but I'll make it a lot smaller just so people can kind of see all the ins and outs and what's required. And the reason we do that is specifically just because when you are, a lot of times you enter into a contract with a realtor and you're going out looking at houses right away, and the realtor, they know a lot of things that they forget to portray.
Yeah.
Things like property taxes, what's your land transfer tax, why is property tax and land transfer tax two different things?
Exactly. And I think in terms of being a client, you hear a lot of terms, but they forget to explain those terms to you. They'll just throw out land transfer tax, and I'll be like,
why am I paying tax twice? Yeah,
exactly. Yeah.
Right. So I'll kind of briefly walk you through it. So right off the bat, what we're going to do is you'll go get a pre-qualification. Okay. So that's what you do at the bank. A pre-qualification is basically how much you can afford. So either yourself alone or yourself and your spouse, or these days it's brothers and sisters buying a place, mom, dad, sister, 3 people on title. So what they're going to do is look at something called your TDSR and GDSR. So that's your total debt service ratio and your gross debt service ratio.
Okay.
So these are a lot of mumble jumble terms that the bank doesn't really get into, but I'll kind of explain to what it really is. The bank is going to say you make X amount of income on a yearly basis. We're going to allocate this amount for your living expenses, mortgage, property taxes, and whatnot. So the bank is not just going to go ahead and give you a loan randomly. They're going to, work through all those things for you. So they're going to look at your credit cards, car loans, other debts, and then these things are going to determine. They're going to offset your income and then show you how much you can qualify for.
Okay.
Yeah.
Got it.
So we won't get too much into that because that's what's done at the bank, but it's basically the first step when you're at the bank.
Okay, so this is before looking at houses, before Go through
Before
for
anything. And realistically, you can look at houses first, but in my opinion, it's one of those things where you're window shopping, and then you might get stuck in love with something that you cannot afford.
yeah.
So I always like to get people a nice range first, and we work out one that's a general range. And if you want, I can actually do that for you right now. Let's just say, for example, you make $100,000 a year. Great life. Varsha's doing
I
well.
do, yeah.
Okay, so what the bank is going to do is say, you can, on average, you multiply that by around 4.5 to 5 times. And that's going to be your mortgage qualification amount.
Okay.
Now, that's a very, very rough number. So that's really when it comes down to is they're going to subtract like your car payments and your credit cards and other things like that. So basically multiply it by 5, and that's kind of the range you're in. And then they're going to subtract other things like your car payments.
Okay, so that's an overestimation of what I get.
Yeah,
qualified
so
for.
let's just say that's a $500,000 mortgage, not a $500,000 house, because also you're going to have your down payment.
Okay.
So your down payment's actually on top of the mortgage. Let's say you have saved $45,000 and you have a $500,000 mortgage qualifying amount. You can buy a place for $545,000.
Got it. Okay.
Right. So that's going to be all worked into your GDSR and your TDSR. Now, this is something that we were talking about just before the show, CMHC fees. Okay. Now, CMHC is something that's kind of a necessary evil. Now, the way it works is it's a mortgage insurance premium that you pay whenever you have less than 20% down. And I know you told me you're thinking about your first purchase, and it's going to be less than 20% down. So realistically, you were thinking, was it 5 or?
Yeah, I'm looking.
Okay,
at
so
5%.
5% as the first time home buyer, and with CMHC now they're going to charge you a premium, which is an insurance fee that allows the bank to lend to you. So basically, what it is the bank is saying, well, if you don't have 20%, we don't want to lend it to you. So the government stepped in. They created this corporation called CMHC, Canadian Mortgage Housing Corporation. And they say, don't worry, a bank. We're going to make sure that person pays. If they don't, we're going to pay you the difference. But who pays for it? You.
I do.
So it's basically an insurance product that you're paying the premium, but you're not the beneficiary.
Okay, so they just help you out a bit if you have the 20%.
Yeah, if you don't have it. They help you out, but you're paying for something that's basically, it's a premium that you're not benefiting from. The bank is benefiting from, but that's kind of how it works. So I won't get into the details on the percentages, but that's something that's a little bit higher level. Now, the cost of home ownership in general, Varsha. So home ownership in general it's quite expensive, and there's things that people forget about. So there's the mortgage, number one, which everyone knows about. Then there's fire insurance. Now, do you know what fire insurance is?
Not particularly,
Okay.
no.
All right. So fire insurance is something that the bank says you need this to get a mortgage. Because if your house burns down and you don't have insurance, but you owe the bank $400,000,
Got it. They're out of luck.
they're out of luck. Yeah. So they don't want to be out of luck. The bank's never out of luck. They always want
No.
people to be out of luck. So they say you need that mandatory fire insurance. Then you have heat. So average heating costs for a condo, maybe in Square One area. That's what you were looking at, right? Okay, so one bedroom or two bedroom condo is going to cost maybe about $40 a month on heat. That's for the newer ones, very much sealed units. They don't really have heat escaping very often. You're going to have water costs. Typically, water is going to be included in your maintenance fees if it's a condo. If it's not, it's going to be probably about $20 on a monthly basis. The water is very, very cheap in Canada, as you know, or as you may have heard. So it's very cheap, Peel region in general.
Okay.
Electricity costs. A condo is not going to be taking a lot of electricity, maybe $45 to $65 on a monthly basis. That's with 2 computers running, your TV, your fridge, stove. And really the reason is because everything is very efficient these days. Even a very large house, you wouldn't really be running over $80 on a monthly basis unless you have something with extreme power draining, like even like a very crazy stereo system, or you're mining bitcoins or something like that, right? Okay, so property tax now. So property tax is something altogether different. It's a monthly amount that you pay, and property tax on an average condo is about $2,500 a year, and they'll divide that into monthly payments for you, and you're paying taxes on the property you own. So that's around 200 something bucks a month. Then you also have your condo fees, which are $300-$400. So in general, that's a whole heap of things that you are paying for that people really forget about. Now, I know this. We wanted to keep this one fairly light, so I'll speed it along. Typically, when you're buying a house, you'll have an inspector. So you want For a condo, you won't need an inspector because the building management will make sure everything's in good shape. And appraisal costs. Appraisal costs, usually the bank will cover that, maybe about $200 or $300. The reason the bank does that is to make sure that you are buying something that has the right value in it. So if the condo's worth $450,000 or it's priced at $450 and you pay them $450, the bank says, hold up, let me just make sure that it's actually worth that before you pay it. Otherwise, it's, you should get a price reduction.
Okay, so is that mandatory, or is that just a
all
nice
banks
thing
will
to
do it the majority of banks will do that in a market that's very stable like now.
Okay.
When the market's going up, they don't really care because they know that the values are there and the values are increasing. When the market is stable or on the way down, that's what's going to happen. They're going to look at that kind of stuff.
Got it.
Then also, I know you were talking about lawyer fees. So lawyer fees are also something that you have to take into consideration. On average, you're going to spend about $1,000 to $1,500 on a purchase. Now, what the lawyer is going to do is take a look at if there's any liens on the property. Say if someone was doing a renovation on the property, they didn't pay their contractor could very easily slap a lien on the property, and when you buy that property, you now inherit the liens. So it's almost like its own person. So you're inheriting its debt, like when you get married to a bum.
Got it.
Right? Okay.
No inheriting debt.
Yes, exactly. Other than that, they're going to take a look at the title search, make sure the person you're buying it from is actually the person that owns it. And they're going to basically take a look at everything in regards to what you need to be safe about when legally purchasing a property.
Okay.
And I know that's, oh my gosh, look at that. We're already out of time of this one particular segment. I'm going to speed it up in next segment. So what I'll do is I will ask our viewers just to stay tuned. I know the section's a little bit more dry, but it's very much important. So stay tuned and we'll be back in just a few moments.
Are you retiring smart? Make your home's equity work for you. With your home's equity and our 30 years of experience, the Retire Smart Properties team can help you achieve the quality of life you've always wanted. Our services are 360 degrees. We'll give you advice, take care of staging and selling, and help you find the perfect home and community to transition to. It's time to enjoy the retirement lifestyle you deserve. Visit our website today to learn how you can use your home to retire comfortably. The Retire Smart Properties team, powered by RE/MAX West.
Hi everyone, and welcome back to this episode of Let's Talk Real Estate. So I'm here today with Varsha Maharaj, and obviously you know myself, AMIT Kanhai. We are just talking about all of the ins and outs of purchasing a property, and is it really impossible to buy a house under 30?
I mean, it seems like it. It seems like it. I know a lot of my friends are thinking about going the renting route because it doesn't seem like it's possible to buy in this market. I mean, things aren't the way that they were when my parents were buying houses.
No, definitely not. And we'll jump into a little bit of that, I guess, in the next segment. But even just to touch briefly, your friends that you referred to me a couple months back, James and Ira, they really, really wanted to buy and realized where they needed to be downtown, they had to rent. And unfortunately, they didn't have any parental support to kind of help them out. So they had to go that route. So we'll jump into a little bit more strategic planning after this segment. So we were talking about lawyers. Okay, so lawyers are going to take a look at the liens and whatever's owing on that property. Make sure you're buying the property from the right person that actually owns it. No frauds involved. It's a little bit costly, $1,500, but that's it.
Yeah, definitely worth it to go through all that.
It really is. And the buyers, they're also going to make sure you get your first-time home buyer credit. So they're the ones that actually apply to the government and say you're going to get your first-time home buyer credit.
Okay, so I can't do that myself.
No,
I don't just
I know you wouldn't want to. It's so complicated, and the law clerk does it every day.
Got it.
So it's one of those things you just boom, you get it, and it's actually an instant rebate, so you don't have to worry about paying the money and then getting it back.
Oh, awesome. Okay.
Yeah, and I don't know if you heard, but last year they increased it from $2,000 to $4,000. So as property prices increased,
okay,
now you get a nice
double
chunk back.
bonus,
Yeah. So that helps a lot when even just land transfer tax is going to cost you around 1% in Peel region, close to 2% in Toronto. So if you're looking at, $500,000 property, your land transfer tax on that is going to be $5,000.
Yeah, so it's essentially what you're going to get back.
So it's great, right? If you get $4,000 back, that means you only have, $1,000 in land transfer tax. You'll basically, when you're buying your condo at $400,000 in Mississauga, you're going to get that thing without any tax transfer because of your rebate, right? So these are things that are important, and even choosing the right lawyer is important because I've seen lawyers forget to apply.
Wow.
Yeah, and it's a really
okay. So do your research on lawyers.
Yeah, or you can just ask your real estate professional, and then they can recommend you to
yeah.
some. All right. So closing costs and down payment costs. We touched on it briefly. So closing costs and down payment costs, I usually lump it all into one, and I say you need 1.5% of the purchase price if you're in Peel region, and you set that aside to make that the number of the cash you should have on hand when closing the property. And I know it sounds like a lot because a $500,000 property would be, $9,000, but your first-time home buyer will also, offset that. So, you're looking at $5,000. And I just tell people, make sure you have that money set aside because you're going to have a $1,500 lawyer bill, $1,000 to $1,500. And then you're also going to have, any other incidentals and whatever remaining amount from your land transfer.
Yeah, it's not good to get surprise bills, so.
Well, exactly, and that's the real problem because what's happened in the past, I've seen, people call me up and say, hey, I ended up purchasing a property with this person, blah, 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 whatever. I know you guys have the talk show. Is there any way I can get around this? I'm like, well, what is it you're talking about? And it's specifically, I didn't realize I had land transfer tax, or I didn't realize the lawyer was this much. And I know it doesn't sound like a lot, $1,500 for a lawyer, but when you are, say you've saved up $30,000 and 27 or 26,000 goes into the investment, goes into the down payment. That little bit of extra money there's not really that much to go around.
Yeah,
to pay the legal bills and all those things. So it's very important to know all of your costs up front. And a very good real estate professional will go through all of these things with you. Kind of like how we do, like I'm actually going through one of our presentations right now. Yeah. All right. There's also a couple tips and tricks that I like to use, specifically because I worked at RBC for 4 years. I worked at Scotia for 3.5 years. I usually tell people to maximize their RSPs. Many young people these days, they don't even know what an RSP is, or if they do, they just know it's something their parents told them to go and do, or their bank has said, go ahead and do that. Have you started an RSP as yet?
I have not, no.
Okay, all right. And there's nothing wrong with that? Yeah. So what happens when you make contributions to your RSP while you are actually earning income? What happens is that, say you make $30,000 a year, and you have $5,000 you want to make to a contribution to your RSP. The bank will now lower your income by $5,000, and then you're actually going to get a huge tax rebate back come March when people do their taxes and the government reassesses. So what's going to happen is you now have $5,000 sitting in your RSP, and then the government may give you $300 or $3,500 back as a rebate, instant rebate. So now you're sitting on, $8,000, $8,500, and you can actually use that to increase your down payment amount.
Okay.
So if you only had $20,000 and you say you took 5 of that out, put into your RSP, you wait 3 months, all of a sudden, boom, now you have $28,500. Yeah. So it's either way, more money. You have more money.
Yeah.
So then choosing a property, I always tell people the most important things on choosing a property are number 1, your location, number 2, your size, and number 3, the amenities. Majority of people in this, in the younger age bracket, under 30, what they're thinking is, I want a fancy place. I don't care if it's small or whatever. The location is actually key because you close to transit is going to save you money on bus routes or parking or all those things. The size, it's always better to get a larger property and then renovate it instead of a smaller property that's already done, because the space you can't add on to a property. You can always renovate an existing, but you can't add on.
Oh, okay.
Yeah, so it makes sense?
Yeah, got it.
All right, and amenities, just small things like granite countertops. They're not very expensive and they're very easy to install, but someone will charge $3,000 for a granite counter that's already installed that only costs $1,000. So
Okay.
you're double and triple and quadruple paying for someone else's work.
Interesting. That's a good point because I would have gone that route. A smaller place, if it looks cool on the inside, great on the inside, renovated already.
Right.
Less work for me, but it's smaller. I wouldn't have thought to do.
Do you
to
recall
the larger.
when we looked at those ones before the show, the mini kind of properties that are
Yeah,
like in
the
downtown
micro-condos,
Toronto,
yeah.
micro condos under 500 square feet? They're beautiful, but they really just look like, you know, like a miniature hotel room.
Yeah.
Yeah. And people would be like, okay, fine, I'll deal with that. But it's honestly the size of this room. Yeah. And you don't want to just be living in a hotel room, really.
Yeah, I think on site it looks great, but once you start living in it, realize it's a bit smaller.
Exactly. And now what I want to talk about now is basically, that's kind of the first time home buying aspect of it. But really, real estate is actually a vessel to build wealth for you. So what I really want a lot of our first time home buyers out there to realize, the dream is not gone of buying that house that you want, the white picket fence and, you know, having the family and all that jazz. It's not gone just because it was very easy for your parents to do it. It doesn't mean it's impossible for you to do it. They did it in one shot where they had, you know, they saved up $40,000 and they bought that huge house that you guys are currently living in for $200,000, right? So it's not impossible. What has to happen now, it's more of a strategic plan. So what needs to happen, you end up going for that condo, a smaller condo at first, purchasing it. Don't rent it. Stay at home if you can. Maybe you can rent out the condo, and then you can be a landlord in turn.
Okay.
So realistically, there's two options. You know, you buy the condo, you live in there for 1 or 2 years, you allow the value to increase, the mortgage is going to go down, and what's happening in that time, you have equity that's being built. So the equity is now going to allow you to 2 or 3 years in the future take some of that money out
To purchase a larger home. So
exactly.
the point of that is to get you into a home, get you out of your parents' house, and also have you accrue a sum of money to then purchase later on.
Exactly, because there's no way you can actually save the amount of money that the property will increase by, because you're looking at a property increasing, say, square one area 4.5% on a yearly basis, 4% for one of those condos. That's, you know, that's $45,000. If you're making 40 grand a year, you can't save 40 grand.
Exactly.
So,
Yeah.
you know, these properties will increase, but, you know, 2-3 years, say that's 80,000 in 2 years, you know, 120,000 in 3 years. You literally just saved $120,000 in 3 years.
Yeah, without having to put it out of your own
Without putting it out of your own pocket. Even better yet, if you just stayed at home for that extra 2 years or whatever it is and rented it out, you'd have someone else paying the mortgage.
Yeah, you wouldn't even be
So
paying
you'd be
for
saving that money, and the person that was renting would also actually be reducing your mortgage amount.
Interesting, yeah.
So when they're reducing your mortgage amount, that 120,000 now goes up to, you know, 150,000. And these numbers may sound really outrageous for someone that's, you know, making $40,000 a year, but it is 100% possible, and it's exactly the way that we do it for our clients. So with that being said, we're running out of time in this particular segment. So I hope you guys are finding this super informative. I'm talking a whole bunch and I need a drink of water. So I'm going to take a quick break and we'll be back in just a few moments.
Think you have what it takes to bring value to the community? The TCN TV network is expanding and now accepting TV show proposals. Here's an opportunity to build celebrity status and become part of an elite group of community advocates that are focused on building, strengthening, and empowering our community in a positive way. Are you interested in embarking on a new adventure? TCN TV is searching for people interested in opportunities to change the conversation and pave an unforgettable legacy. If you feel you have something of value to offer, send a written show proposal to shows@mytcntv.com.
Are you retiring smart? Make your home's equity work for you. With your home's equity and our 30 years of experience, the Retire Smart Properties team can help you achieve the quality of life you've always wanted. Our services are 360 degrees. We'll give you advice, take care of staging and selling, and help you find the perfect home and community to transition to. It's time to enjoy the retirement lifestyle you deserve. Visit our website today to learn how you can use your home to retire comfortably. The Retire Smart Properties team, powered by RE/MAX West.
Okay, welcome back everyone to this episode of Let's Talk Real Estate. This is a very informative episode. I'm here with Varsha Maharaj, first-time homebuyer, and we're just trying to figure out: is it impossible to buy a house? Is it impossible?
That's what I thought before coming here.
All
It
right,
seemed like it.
so we're halfway there. So realistically, I'm just ending off on the tail end of the investment properties.
Yes.
When you don't want to live in that property, you're gonna accrue so much more savings and equity if you're just staying at home for that extra 1 or 2 years, and you own that property. I did that myself, but that was 5 years ago, and I was 24, and bought my first place, stayed at home for 2 years, and it went up by $100,000.
Okay, so the optimal route here is to just stick it out, stay at home,
Yeah.
and then have that property accrue.
Ideally. And I know everyone, at 25, they're saying, hey, my parents were married and they had 2 kids at this time. It's like, hey, this is not that time.
And that's what I think
Yeah.
throws a lot of people off. It feels like that there's a timeline that you have to be doing things by, but you have to realize the end goal is the same, but the process has changed.
Is completely different. Yeah, exactly.
So you just got to play the game a bit differently.
Yeah, and we're our generation's starting things a little bit later than the average. So it's just, it's there's more education involved, and that takes 4 years, sucks 4 years out of you and your pocketbook.
Debt on top of that.
And all
so.
that, exactly. So ideally, if you just stay at home, rent it out for a few years, let that thing increase in value, and then you automatically have like money that you can pay off your $50,000 student loan with, and then still $50,000 to put towards another property or something like that.
Okay.
So it's more about a strategic plan. So that's step one, the condo. And if you want to live in it, fine, why not? But there's lots of people that are out there that are looking to rent. So if you do have access to some savings, or even parent savings or whatever, family savings, I highly recommend have your real estate agent come on over and discuss it with your parents, because what's going to happen is a lot of people are embarrassed to ask, but there's a lot of equity in these properties your parents have purchased 20 years ago that really they have no idea what to do with. In some cases, there's like $8, $9, $100,000 available,
Yeah.
and we're not planning on doing anything with it other than retiring one day. And 40 grand is not going to hurt them, right? So that's kind of how I look at it with that aspect.
Okay, so then they would be taking that money out for the down payment of the condo that you're
Exactly.
Okay.
And the banks are now allowing gifted funds, which was a problem in the past. So they're allowing gifted funds from parents, grandparents, as long as you're a direct relative.
Okay, so it doesn't have to be your own money.
No, it used to have to be personal savings. Now it's no longer the case.
Okay.
Because
good to know.
they're understanding that there's no way to get
they've understood that things are
the
changing
youth,
rapidly.
the next generation. Exactly. Okay, so then now fast forward, you've taken out some equity of that place. You still have that tenant living in there. You've taken out $100,000. Now you purchase a townhouse. You move the step up. So you're going from a 500 square foot place, and now you're living in either a bungalow or a townhouse. And then you can move into that place if you like, because now you have a little bit more independence. These bungalows are not super brand new, but they're not horrible. A lot of them are very much renovated. Or you can go the condo townhouse route or the regular townhouse route. And when you're looking at that, you have a little bit more space. Maybe you're still under 30 and you have a place to call your own. So realistically, that's the place that I tell people you spend your your youth years. You're meeting people, working. Who knows? You get married, and then together you can kind of move equity from condo 1, townhouse 2, buy your final property.
Okay, so the steps to getting towards your goal essentially is just moving money from property to property.
Yeah, and you're using equity that's built up based on the fact that real estate continues to increase, and historically real estate has always increased. There's no more land, they're not making more of it. So real estate will continue to increase over time. Even if it's a very nominal increase of 1.5% or something like that, it always or even there's a dip, it always rebounds, and it always rebounds very quickly.
Yeah, and with these figures, even a 1%, actually 1.5 is a substantial amount of money.
Well, definitely. Imagine, you go to the bank, and I know this because I was a banker for many, many years, that they say, okay, don't worry, put away $100 a month and blah, blah, blah. We're going to give you 1% on it. What's $100 on 1%? It's $1. So you can't even buy a coffee.
Yeah.
So at least if you're using the bank's money and the property is increasing, you use the bank's money to buy that $400,000 condo, it increases by 1%. That's $4,000. And realistically, it's probably going to increase by 4%. So, you multiply that by 4, and, you're in the $20,000 range per year, $25,000 per year. So this is kind of a way to use the bank's money to make you money.
Yes, to accrue your own wealth.
And ideally, there's nothing wrong with taking advantage of people that need places to stay and they need a short-term, a 1-year rent or a 2-year rent, because a lot of people are not as fortunate to have parental money that they can kind of use in these situations.
Yeah, there are always going to be people needing to rent places.
Exactly, yeah. Especially with, the majority of, I think there's supposed to be 1 million immigrants coming to Canada in the next 1.5 years or 2 years, and around 60% of them are settling in the GTA.
Okay.
So they come and they need somewhere to rent for the first couple of years while they get themselves set up.
Yeah.
Why not be their landlord? They could be older than you. It doesn't really matter. So it's just kind of, you set your mind to something and we can kind of help you get through it.
Okay, got it. So in terms of timeline, we would purchase the condo for the investment. Say I'm 25.
Yeah.
So and keep that for about 2 years. So you're saying by about 27, so still under 30, I would be able to purchase.
Exactly. Yeah.
Place.
Yeah. And there's no rule against saying you don't live in the condo. But I just say that it's better if you have someone else paying the mortgage.
Yeah, it just makes more sense.
Over 1 year,
over
1 year they're gonna pay $10,000 off. And then you're gonna have that money that you could save an extra $10,000. So it's just gonna really compound, and it makes you a much more savvy investor.
Got it.
Yeah. Okay, so and then you end up buy your house whenever you want at that point. But for real estate, it's buy, hold, and profit. So
yeah, it's a long-term thing.
Yeah, it's a long-term game, exactly. So any other questions on how that works?
I think with the investment stuff.
Okay.
Yeah.
All right, good. Now, a lot of people they're just scared to ask questions about this stuff. So, I always tell people, email us, ask questions. And I'm sure you have a lot of friends and family with, questions that are exactly the same.
Yeah, it's definitely a daunting thing because it's not like it's explained to us in the school process. So you kind of get out and you're like, what's a mortgage? Even mortgages is something that I'm kind of...
It's a scary, weird term. Like, is it a loan? Is it a big, loan that the bank
how do I apply for it? What do I need to get it? Do I qualify for it at 25? Like, it just seems like something that's so far away.
Yeah.
That, like, a young person, like, I don't need a mortgage right now. And it's like,
well,
it's a daunting thing.
I particularly have issues with the school system that not teaching people this. And it's one of those things that you really have to go out and seek outside education. And, it's kind of hard when you go out to university and you spend $50,000 and you have all this debt and you're like, well, what do I do?
Yeah, exactly. It's confusing. And you don't know where to turn. Not everyone has a realtor on hand at 25 years old. So
well, also it's a what I've noticed is particularly people are scared to ask.
Yeah.
And I find myself on the much more approachable spectrum of the average realtor, and people are still afraid to ask me questions.
Yeah.
So the average big shot that you see on a billboard, no one's going to be like, hey, can you answer?
Yeah, just email you my questions.
Can you hey, this is my question. So I encourage you guys to ask questions, call in. Numbers on the screen: 647-931-4701.
I do actually have another question.
Oh, yeah.
In terms of sticking in the GTA and going to Toronto, what would be the differences in the kind of income that I would need to have or qualifications I would need to have to get a mortgage down there versus here?
Okay, so that's a good question. And the funny thing is, well, not the funny thing, in Ontario in general, mortgages are the same regardless. So you can get the same qualification amount just based on your income. But what's going to happen is that 2-bedroom condo in Square One area that's going to be $450,000 is going to be probably $600,000 downtown, or $550,000.
Okay, so the qualification is the same. It's just in terms of what I can get.
What you can get for the price range.
Mississauga versus Toronto.
Yes, and then even you can look at Brampton, you can look at Scarborough Town Center, different areas like that. So it's really just based on the amount that the condo is valued at and what they're selling it for. So that's really the only difference. If you are working downtown, a lot of people go with the micro condo route now, which is very, very small condos, 500 square feet or less. Basically, you turn around twice. You're in your kitchen, your bedroom, your washroom.
Yeah.
Like, that's it. Everything's right there. 1 square, kind of a hotel.
Okay.
Yeah. But on that note, what I'll do is I'll just ask our viewers to stay tuned. We're going to take a quick commercial break, and we'll be back in just a few moments to do a market update and just cap off some of this stuff.
Are you retiring smart? Make your home's equity work for you. With your home's equity and our 30 years of experience, the Retire Smart Properties team can help you achieve the quality of life you've always wanted. Our services are 360 degrees. We'll give you advice, take care of staging and selling, and help you find the perfect home and community to transition to. It's time to enjoy the retirement lifestyle you deserve. Visit our website today to learn how you can use your home to retire comfortably. The Retire Smart Properties team, powered by RE/MAX West.
Welcome back, everyone, to this episode of Let's Talk Real Estate. Here with your host, AMIT, and we have Varsha Maharaj here, just asking questions as a first-time home buyer. This very daunting task, as you so eloquently put it.
Yeah, it's a confusing and daunting thing.
Mm-hmm. So, any other questions and concerns? How to go about getting the mortgage? Tell me some questions or issues that your friends in general are having.
I think mortgages is a big thing. That whole process, I don't think anyone really is clear on. So if you could touch base on that a bit.
And student loans, I guess.
Yeah, how that factors into what you can get qualified for.
Well, you know what? Let me jump into that for a second, because usually your mortgage agent or bank will actually give you a little bit more details on that. But a very large student loan of $40,000 or $50,000 is definitely going to affect your mortgage qualification amount. The one good thing is the student loans, they keep the payments fairly low. It's interest only when you're in school, and then there's the interest and principal portion is not massive when you're out, but the thing is that you're paying majority interest.
Okay.
So the payment is still fairly low, but it'll take, if you look at the actual statement student loan sends you, the amortization on that, it would take you, like 50 years to pay it up if you just paid the minimum payment. So it's one of those things where I strongly encourage seeking some help from family members and whatnot for increased down payment amount. And even if you need to get a cosigner on there, mom and dad, if they have their property paid off for, or even if it's halfway paid, a lot of the times the first property, I encourage people cosign with mom and dad and have their income plus your income.
Okay, and just for people that may not have heard that term before, what would that entail in terms of asking your parents to do that for you?
So basically what it is the bank is going to say, listen, you make $30,000 a year, and that's only going to qualify you for $120,000 mortgage. Well, there's no houses for $120,000, and there's no condos either.
Good luck.
Yeah. So you can say, okay, mom, you're making $40,000, $50,000, whatever it is. Mom, co-sign with me on this particular property, and they're going to add your incomes together. It's going to increase your qualification amount.
So it's just giving you extra clout to be able to get the mortgage that you would need.
Exactly. And really, all that's happening is mom is saying, hey, I'm lending you a little bit of money, and my name is on there as well. But what the bank is saying is, hey, mom's on the hook in case you disappear.
Okay, so they're not losing out.
Exactly.
They don't like to lose out.
That's the only rule of this. The bank never wants to lose.
Okay.
Yeah. So they're going to say, okay, let's go for it. We'll get you your place, and that's great. Then you don't have to live in that place. You rent it out, and that's a great investment. It's such an amazing investment for people to build wealth.
Okay.
Yeah.
Real estate is the way to go in terms of investment.
Honestly, it really is. And working at the bank for 8 years, I sold mutual funds, I sold investments, I did all of those things. I have my PFP, my IFIC, my CSC, all the courses that you can get at the bank, and I was a financial planner. And I realized after all that time that you're not making any real money on that. It's going to take you literally 50, 60 years to get to your retirement goal.
Yeah, to make any sort of substantial return on
Exactly. And just to kind of jump back into the investment section of things, now one property as an investment will typically buy another property within 5 to 8 years. And what that means is as the property's values increase and the mortgage goes down, the portion that's the equity will allow you to buy the next property, obviously. But then within 20 years, those two properties will typically buy 2 more properties. And I know it sounds like a huge, long time frame, 20 years. You've only been alive for 25 years. So, realistically, what happens is you just have to set manageable goals and expectations that you want to be somewhere by X amount of years. And it's just about properly planning. And if you plan like that, so 2 properties are now buying 4 properties. This is 20 years out, and you're 50 years old or somewhere in that range, and you have 4 properties. I myself did this. I'll share right now. I'm 31, and I have 3 properties, and 2 of them rented out. It works. It works. It works. You have people that are living in there that are great people. Some of them were making. My first tenant was making more money than I was at my first property. I was living at home. I was 24 years old.
Yeah.
And the fact of the matter was his credit was a little bit bruised. He was just got married. He had a kid, and they just needed somewhere to live. They had no family help or anything like that. They are excellent people, and they've been there for 4.5 years.
Wow.
Yeah.
Okay. That actually touches on another topic I wanted to talk about, credit. How is that going to impact you in terms of mortgages, in terms of getting qualified?
Right. Credit is super important, and my major beef with universities and colleges, day one you walk in, hi, welcome, here's your credit card. Like, it's the first thing they do. You have no idea how to manage that thing, and it's super important. So credit is one of those things where you don't have any credit until you apply for credit, but you can't get credit.
Yeah, it's one of those tricky systems where you need to use it, but then you don't have it unless you do use it. You don't want to use it too much.
Exactly.
Yeah, it's a slippery slope. It
Yeah,
definitely is.
and realistically, so you need credit cards or any sort of outstanding debts that are over $2,000 in value, and you have to be paying it on a regular basis. So credit is something where I recommend people, instead of using your debit card for what you were literally going to purchase with cash, use your credit card. And then when you get back home, just transfer it. Pay it right off. You could even wait the 29 days. I'd say wait, instead of 30 days, that's when they actually charge the interest. So if you pay it off in 28 days, you're not going to pay any interest. So just keep track of all those things that you were purchasing, month by month, your pizza, your McDonald's, your gas, whatever it is, and then just pay it off right away. And when you do that, your score is going to increase dramatically. Another thing that many people don't realize, and this is because I've worked in the banking sector and in the real estate sector, is you can actually just purchase, increase your credit limit. Always ask for a high credit limit of over $2,000. If you have a credit limit under $2,000, it doesn't even show up on the bank's radar for mortgage qualification.
Oh, okay.
And that's something that many people don't know. So increase it, even if you're not using it. The more credit you have and not using, the more credit the bank wants to give you.
So you want a good looking ratio.
Exactly, the ratio, exactly. So that's actually brings us back to section 1 where we talked about your total debt service ratio and your income ratio. So that's exactly what it is. So instead of income, we're talking about credit now. So it's good to have a $5,000 credit card with $500 owing on it, and you pay it off every month. Or even, as long as you have a decent amount that's like less than 50% of owing on it, you're in good shape. And the bank, that means your credit's going to be very high. The bank really just wants you to be having a balance that's under 80% of the value.
Okay.
So if you have a $10,000 credit card, they want you to have less than $8,000 outstanding on it. But I would recommend you have, much less because it's interest payments.
Yeah, I heard between like 30 to 20.
Yeah, definitely. And if you really can, pay the whole thing off, you know? Yeah. So all that is going to do is say you're more favorable in the bank's eyes, and they're like, hey, I want to give you money.
Okay, yeah, they kind of use that as a judgment factor, as how accountable are you?
Exactly. Are you good with money?
Yeah.
Yeah, that's really all they're doing. And try to apply for maybe 2 cards. Many people say you don't want too many cards. 2 is enough. Just make sure you have 2 over $2,000, and you should be good when it comes to qualifying.
Got it. Okay.
Yeah.
That's good to know because I didn't know the $2,000 thing. I have one that's $1,000 and one that's $5,000. So the $1,000 card isn't doing me much.
No, it isn't doing much. You increase it, yeah. And also you can even do balance transfers back and forth. So there's a lot of cool things in the system that allow you to save money on interest if you have any balances owing on them. But now that we are coming close to the end of this very informational segment, we would like to do a market update. And I always like to ask my guests, first question, where do you think the market's going?
As far as I know, last time that when I exited this industry, it was kind of balanced as far as I understood.
Yeah.
Kind of equal buyer, sellers. I know that anything over $1 million was kind of sitting there.
Yeah.
So I'm not sure if it's the same right now.
It really is. And luckily, you have a very unique perspective that is probably 5 times more the average person your age, specifically because you worked in the field.
I did have that benefit. I learned a lot.
Yeah. So really what's happening, Condos are shooting up in value consistently.
always,
Yeah. Very much more so now than, 5 years ago, because with all the new tightening and mortgage rules, the condos are actually just the only thing people can afford. So that's their first step, and that's what they can afford. But I tell people, as we talked about in previous segments, go for the condo. Don't bother renting a bigger place, because you could rent a house for $2,000 a month, or a bungalow, or you can spend that 2,000
Put that in
buying
something
your
you can own,
500,
yeah.
your condo, your mortgage and whatnot. So it's better to own a smaller thing than to rent a bigger thing.
Yeah, I think that's important for people to realize is you just might need to just scale down the dream a bit, but you will get there eventually. It's a scaled down version.
And
of
you
it.
just have to plan it. That's
Yeah.
it. There's nothing wrong with planning your future. And obviously nothing goes exactly as planned, but you just want to make sure that you have a roadmap. Of
Yeah,
what's
some
gonna
sort of
happen.
guideline.
Exactly.
Not just winging it.
So yeah, that's kind of where the market is at for condos. For larger properties, anything 600,000, they're selling 600 to 800, but it's taking a little bit of time. And like you said, anything over $1 million is just sitting.
Yeah.
It's a luxury purchase. Who has $1 million?
It is, yeah.
Yeah.
I mean, who does? But in the 600,000 range, those are still, you're looking at townhouses, condos.
Yep, condo,
In the GTA.
large condos, like 2 bedrooms in Toronto, maybe. In the GTA, that's townhouse territory,
Yeah.
and also, in Peel region, that's townhouse territory, or in Brampton, that's bungalow territory, which is a nice big.
Okay, so you can still get a nice
space.
sizable bungalow for
Yeah.
600.
Yeah, you just have to move outside of the area you were originally intending.
Okay, so that's more of the Brampton.
Yeah, or you can go to, Burlington if you really want to go that far out. There's a lot of nice stuff in Milton. And again, Oshawa, Ajax, Pickering. East side is still fairly well priced as well, depending on where you want to situate yourself.
Do you find people are still moving outwards further out, like into the London area?
You know what?
St.
In
Catharines?
the last 3 years, everyone was moving out. I probably had 1 out of 5 buyers that were selling here and moving out to a cheaper place
Yeah.
in Kitchener, Cambridge, Waterloo, Hamilton, Barrie, Orangeville, and Shelburne. All in last year I've sold
Yeah.
those.
Okay.
Now what's happening is now the prices have stabilized. People are saying, it's fine. We'll continue to buy here because it's not increasing by such
Okay,
a
so that's kind
rapid
of slowed
amount.
down the moving out, like further out of the
Yeah, and now it's more like just outskirts as they develop the outer ring of North Brampton, and they extend Milton and different things like that. Even Oshawa, the transit is so excellent that a lot of people working downtown just live there and jump on the train.
That's the thing, a lot of transit improvements too in these newly built areas.
Yeah, and if you think about it, you can actually just live on the subway line right up to Yonge Street, all the way up to Eglinton and or 401 and Yonge, and you can zip right downtown. And maybe,
Exactly, you don't have to spend all that money in the downtown core anymore. Just zip down. on the
Exactly, and you're
subway.
probably looking at a reduction in price of maybe $150,000 from living north of the 401 on Yonge Street into downtown core, and all that will mean, Varsha, is a 20-minute train ride.
Yeah.
It's not that big of a deal.
Yeah, it seems like a jump, but it's
Yeah.
not really. It's worth it.
So the main takeaway for this particular episode is it's not impossible.
yeah, that's
Yeah.
what I've learned, definitely.
Yeah.
You've given a lot of roadmaps, I think, to reaching people's
Awesome.
end goal.
Oh,
so.
great. Well, I really want to thank you for coming out today.
Thank you for having me.
and
Thanks for all this knowledge.
No problem. And I want to thank our viewers for tuning in. Also, I just want to let everyone know that tomorrow, that's May 11th, the Caribbean Children Foundation is having their Fet for a Cause. That is at the View, 195 Galaxy Boulevard. All for a great cause. $20 for a ticket, and everything goes to charity to help sick children. All right. I hope to see you there, Varsha, and
I
I
will
hope to
definitely
see
be there.
you guys there. Take care.